3 stocks at 52-week lows. Let's check out if they're a buy or not. Caterpillar, Nvidia, and Micron Technology. So here's our stock analyzer, our software. Guys, if you're already a subscriber to our software and you're part of the EM community, open up your browser, start watching it with us. If you're not, you're going to love the software. Just check it out. Easy to sign up for. So first one, Caterpillar. We just type in cat. So first thing, we're going to look at the chart. Wow, look at that drop. Just recent. Oh my gosh. June 8th, it was 230. It's currently at 170. 52-week high is 237. 52-week low is 170.66. Probably reached that today. All right, let's go to the 8 pillars. So guys, here are the 8 pillars. A lower ROIC, which doesn't surprise me. It's a big company. It's going to be hard for them to deploy their capital and get high rates of return, but 7% is not awful. Higher debt. So what's one thing? Remember, the 8 pillars here won't tell you to buy or sell a stock. It's merely a screening process. First thing I'm going to ask is, why do they have so much debt? Find out why they have so much debt. And finally, their price to free cash flow is a little high. So it doesn't match up with their PE, which is a little bit lower. So that's something else to check out. Why are the PE and the price of free cash flow are not even close to the same? They're 20% difference. All right. So I'm just going to take a quick sneak peek at the income statement because I really have to check the revenue. So guys, look at this. 63 billion, 55, 55, 43, 39, 48, 55. I mean, all over the place. So this is Caterpillar. My first question is, do they sell stuff along the way? Do they buy things along the way? Because it's a lot of drop for such a big company. Or they sell a lot of major equipment. Just maybe if there's a slowdown in buying equipment, it's going to drive down prices and revenue big time. So keep this in mind when we go to the stock analyzer tool and make our assumptions about the future, right? Because right now, they're actually lower in revenue by 20% than they were 10 years ago. That's a big drop for such a big company, okay? So let's go scroll down a little bit to the net income level. Now, their net income looks a little more consistent. It's still dropped, climbing back up. Now, Caterpillar sells very expensive big equipment. We are on the tail ends of an economic boom. And if you saw our previous videos, you'll see that maybe where the economic boom is slowing down. And guys, I'm Paul. This is Everything Money. If you like this video, please subscribe to the channel. There are over 1,600 videos in our history, and we post 2 per day. So subscribe to the channel. All right, so let's go check out the stock analyzer tool, our most famous tool. What this allows us to do is make our assumptions about the future based on the past, and it'll tell us what to pay for the stock today based on those assumptions. Now remember, these assumptions are, I'm going to tell you how I get to them, but it's not to be set in stone. We don't know the future. We're just making reasonable assumptions. As Warren Buffett says, he doesn't buy a company unless he has a reasonable idea of what they're going to make over the next 5, 10, or 20 years. So in this situation, I picked 10. Year analysis, you can pick 1 to 20. So revenue growth. Guys, look at this. -2% a year for the last 10 years. So I'm going to do -2, 0, no, -2, 1, and 4% revenue growth. Profit margin. They range from 7 to 12%, but the 12% is the most recent 1 year. The 7.3 is more consistent for 10 years. So I'm going to go 7, 8, and 9%. You might sit there and say, well, Paul, they did 12% last year. I know, but it's also 1 year of data on 10 years and tail end of an economic boom, a lot of pent up demand as you saw in a lot of companies. So I'm going to be more conservative on that one. Free cash flow margin, much more consistent on the 5 and 10 year numbers. I'm going to do 7, 7.5, and 8. Now, why didn't I do 7, 8, 9? Well, because the 5 and 10 year numbers were 7.5 and basically 7.5. So I'm just going to keep it more consistent. If they do a little bit worse, it's 7, a little bit better, it's 8. Very simple. Now remember, guys, don't get caught up in these very minute details. What I want to make sure you're not doing is putting in 10% here. I'd be like, well, where'd you get 10% from here? And they haven't done 10%. And even here, if you did 10%, I'd say, okay, maybe that's the high end, but that shouldn't be your low end. Go on the past to see how they're doing. And also keep in mind that during economic booms, margins are bigger. So you should contract those margins a little bit. Now for PE, I'm going to go with 12 on the low side, 14 in the middle, 16 on the high. And the same with price to free cash flow. And my final desired annual return, I usually do 12.5%, especially for larger companies. Why is that? Because you can get 9 or 10% just by investing in a long-term ETF. So give yourself margin of safety and a reason to buy an individual stock. So when I hit the analyze button, it's going to tell me based on these assumptions, what I should be paying for the stock today. Scroll down. All right, guys, the stock is at 171. Even though it's a 52-week low, according to these numbers, we got a long way to go. We have a low of 55 and a high of 120. And the middle numbers is around 80. So we got to fall basically in half. You might sit there and say, oh my God, Paul, half? Well, remember, this 14 PE becomes 7. You're like, Paul, it's insane. But they're also coming off of really, really high profit margin in that 1 year. So this is a PE that's not exactly accurate. This is purely math, guys. If everything stays the same in this company, but they hit this level, the middle level, you got to pay $80 to get a 12.5% return. So what do you have to pay? If you pay today's price, what return are you getting? Well, we have to work a little bit backwards here. Let's go 5% return. Guys, if you change the 5% return in the middle section, you're still not even there. You're in about a $130 price. So paying today's price of $171, you might be getting a 2 or 3% return because of the long run, stocks are a weighing machine. In the short run, they're a voting machine. So Let's go to the next stock, Nvidia. Now we're going to go through this one a little bit quicker because we already have explained some of the things here, but let's go look at Nvidia. Wow, look at Nvidia's chart. A high of 346 and a low of 140. Guys, I remember people thinking I was crazy. Go look at our past videos about Nvidia. Paul, you're crazy. This stock won't fall by... Okay, sounds good. But look at this. It's fallen by over half in 6 or 7 months. Over half. So let's go to the 8 pillars tab. All right, so they've increased their shares outstanding just a little bit in the last 5 years. Not a ton, but just a little bit. And I don't blame them. Expensive stock. Go issue shares to everybody. They want to buy your shares. Don't take on debt to fund your business. Issue shares. But look at these PEs and price of free cash flow. 73, 75. Pretty close together. All right. Anything else here I want to take a look at? Ooh, look at this high return on invested capital. 13%. I like that. Very low debt. I like that too. Okay. Everything else looks good. So let's go to our stock analyzer tool. Now, stock analyzer tool. Look at these revenue growth numbers. 1 year is a 53%. 5 year, 28% a year. 10 year, 23.5%. It will not likely grow that much. My goal is to be conservative in all my assumptions because there are 10,000 stocks out there. I want to find the 20 to 40 that fit my criteria. The company last year did how much in revenue? We go to the income statement, 30 billion in revenue. If they were to grow at 25% a year for the next 10 years again, 1.25 to the 10th power times 30 billion, they would do $280 billion in revenue. That would be 4 times larger than Intel today. Is it possible? Yes. Is it probable? I'm here to make investments based on the probable outcomes. And I just don't think 25% growth for 10 years is probable. So I'm going to put in 7, 10, and 13. Profit margin. So going on these past numbers, I'm going to go 25, 28, 31. Same with free cash flow. My PE, 14, 16, 18, 14, 16, 18. 12.5% return. Now, guys, you look at this PE and price of free cash flow. But Paul, it's 39, it's 46. Well, yeah, but 6, 7 months ago it was 100. Does that make 100 reasonable? You still have to go based on historical numbers because a dollar of cash flow does not care about anything besides it's a dollar of cash flow. It doesn't care where it came from. And I put a higher PE for higher growing companies. Now, is 14, 16, 18 reasonable? I don't know, but we'll check it out and we'll see the differences. Let's hit the analyze button. The stock's at 147. So it's going to fall in half from here if you want to hit these middle assumptions. You hit these middle assumptions, then you have to be at $70. The low is 47, the high is 105, a middle of $70. So my idea is I would sit there if you have the software, hit the plus button at 105. What this does, it adds it to your watch list. Notify me when it hits below 105. And that way, when it hits, you'll get an email and a message on your app and it'll tell you, hey, go check out Nvidia. That doesn't mean go buy Nvidia. It means go check it out. Have the fundamentals gotten better? Do I need to do more research? You probably need to do more research because it's a very high level view of it. Final stock, Micron Technology. Now, Micron's a big one for Monish Pabrai. Monish is a friend of the show. He loves Micron. He loved it back at 90, and I'm quite sure he loves it at 56. Let's see what he sees in it, okay? So as I said, look at the 52-week high, $100, 52-week low, 52. And it's currently selling for $55 a share, $56 a share. Wow, it's up 4% today. Holy cow, today's a down day in the market by a good chunk, and it's up 4% today. Let's go to the 8 pillars. Now, a lot more red X's here. But remember, again, this is not to tell you to buy or sell a company. It's about telling a story. So right here, a lower ROIC, net income has fallen, minor shares outstanding, and cash flow growth has decreased. So these are all questions of, my biggest one is, why is net income and cash flow fallen over the last 5 years? Because this really isn't a lot of shares outstanding. It doesn't bother me that much. I just want to make sure I'm not issuing huge amounts of shares, okay? But right here, look at this PE. 5-year PE of 8, 5-year price of free cash flow is 16. So of course I want to ask, why are earnings and free cash flow so different here? All right, so let's go to our stock analyzer tool. Now, revenue growth numbers. I'm going to do 6. I'm going to do 5, 8, and 11. I'm going to do profit margin of, oh wow, look at this profit margin. Now, this is what throws me here. The last 5 years have done 29%, but 10 years have been 22.8. So let's go 22, 25, 28. Free cash flow margin, 11, 13, 15. PE, 12, 14, 16, 12, 14, 16. Now, guys, look at this. The current PE is 7, and I went to 12, 14, 16. I'm not going lower than 7. Why? Because 7 is an unreasonably low, especially for a company that's existing and good and great. That's way too low of a PE, in my opinion. So I'm going to go put it higher, okay? I'm not just always here to drag it down. I'm going to put it higher. And finally, my 12.5% return. And we're going to hit the analyze button. And again, the company's currently, it's already gone up in a few pennies since. $56, and this is probably why Monish likes it. It's pretty much all green, but there's wide ranges. Why? Because price, profit margin, and free cash flow are very different, almost half. So you got to find out why. But right now, if you like these assumptions, you got to take a look at the stock further. Go figure out why these numbers are so different, and go find out what Monish's whole entire thesis is. So why do we go through these videos like this? We really believe the more you know, the less you fear. The future out there is unknown, but the more you understand about what affects it, the better you will do and less fear you'll have. If you like this video, please watch a past video where we did 52-week lows on Microsoft, Intel, and Disney. Thank you very much. Like and subscribe.